Hey there, Singaporean investors. If you're keenly interested in OUE REIT and you're wondering whether to buy more of this stock or perhaps even consider selling it right now, you are absolutely in the right place. I'm Iggy from the Investing Iguana, and in this video, I will provide you with a candid, balanced breakdown focusing on 3 compelling good points that make this REIT attractive. And then, just as crucially, 3 significant bad points or red flags you absolutely need to be aware of. And make sure to stick with me all the way to the end, because in the final segment, I will give you my personal investment advice on whether to buy, sell, or hold this particular stock for your portfolio. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We've crossed the 1 million mark for reads, and with over 900 videos and 500,000 watch hours, content is literally all I do. I also focus on regional and global economic trends, giving you that broader context. If you're serious about uncovering the hidden gems and potential pitfalls in the Singapore market, you'll want to hear this. Let's kick things off with the positives. For OUE REIT, one of the most compelling strengths we've identified is its investment-grade status combined with premium Singapore assets. Think about it. In Singapore, stability often translates to strong long-term returns, especially for CPF investments. This REIT holds an S&P BBB- rating, almost acting as a fortress that protects it from credit risks. We've seen this play out in its consistent operational performance, even during challenging economic times, which is evident from its latest financials, showing a remarkable 96.3% office occupancy rate as of March 2025, with positive rental reversions of 9.9%. This dominant position provides a strong foundation, but is it enough to guarantee future success? Moving on to our second good point, its robust dividend yield and defensive characteristics. For many Singaporean investors, passive income is key, and this REIT has a history of consistently distributing dividends with a current yield of around 6.9%. This isn't just about income. It reflects strong cash flow generation from premium Singapore properties and a management team committed to returning value to shareholders. Consider how this steady stream of dividends could compound your returns, especially if you're reinvesting through a dividend reinvestment plan. It's certainly a comforting thought in today's volatile market, isn't it? And finally, the third positive aspect worth highlighting for OUE REIT is its strategic portfolio positioning in Singapore's most resilient sectors. It's not just about what properties they own now, but where they're located. This REIT has strategically positioned itself with grade A office properties in Singapore's central business district, including One Raffles Place, valued at 1.9 billion Singapore dollars, plus premium hospitality assets like Hilton Singapore Orchard. These properties are expected to benefit from Singapore's tourism recovery and the safe haven status of Singapore real estate, potentially leading to significant value appreciation in the next 3 to 5 years. Are these ambitious expectations truly achievable, or are they just wishful thinking? We'll dig deeper into that. Now, let's turn our attention to the flip side, the 3 critical red flags you need to consider before making any investment decisions on OUE REIT. The first significant concern is its limited growth visibility and declining distributions. While stability is good, stagnant growth can be a serious problem. Their latest financial reports reveal distribution per unit declined from 2.09 cents in 2023 to 2.06 cents in 2024, with no clear acquisition pipeline in sight. This could impact its ability to drive meaningful income growth for unit holders, especially concerning for income-focused investors here in Singapore who rely on steady distribution increases. How much growth stagnation is too much, and at what point does it become a real threat to shareholder value? Our second red flag is significant exposure to volatile hospitality sector cycles. Even defensive REITs aren't immune to sector-specific risks. We've recently seen the hospitality segment, which represents approximately 32% of OUE REIT's portfolio value, experience weaker performance in Q1 2025, with revenue and net property income declining 13.3% and 12.5% respectively. This increased volatility could erode overall portfolio stability and put pressure on distribution sustainability in the coming quarters. It's a classic case of putting too many eggs in one volatile basket. Will the REIT be able to weather tourism cycles effectively? For even more granular data, in-depth charts, and a full written breakdown of OUE REIT's financials and strategic outlook, make sure to check out our Substack. The link is right there in the description. Finally, the third major concern for OUE REIT is its higher leverage and interest rate sensitivity. Diversification isn't just for portfolios, it's vital for managing financial risks. With aggregate leverage at 39.9% compared to the S-REIT average of 38.5%, plus sensitivity to interest rate movements through refinancing requirements, this makes it highly vulnerable to rising borrowing costs or credit market disruptions. This concentration of financial risk is something Singaporean investors, who often seek stability, must seriously consider. What happens if interest rates rise faster than expected, or if credit conditions tighten significantly? These are the questions that keep seasoned investors up at night. All right, we've weighed the good against the bad for OUE REIT. We've looked at its investment grade status and premium assets, its attractive dividend yield and defensive characteristics, and its strategic Singapore positioning. But we've also squarely faced the challenges: the limited growth visibility, the hospitality sector volatility, and the interest rate sensitivity. So what's my overall assessment for OUE REIT? This is a REIT with strong fundamentals and attractive income generation, but it's currently navigating some significant headwinds that demand careful consideration. Considering all these factors, my personal rating for OUE REIT is a hold. My clear justification for this is that while the underlying asset quality and investment grade credentials are solid, the limited growth prospects and sector-specific volatility create too much near-term uncertainty for a strong buy recommendation right now. Similarly, its strengths prevent a sell rating, as there's still significant long-term value in this premium Singapore portfolio. For Singaporean investors, my strategic advice is this: if you already own OUE REIT, holding on to your units makes sense if you're invested for the long haul and are comfortable with the identified risks, especially given its attractive 6.9% dividend yield. However, for those looking to initiate a new position or add to their holdings, I would advise patience. Wait for clear signs of growth initiatives or improved hospitality performance before committing new capital. This REIT, while robust, requires careful monitoring in the current economic climate. Is it a good fit for your CPF portfolio? Potentially, but only if you have a very long investment horizon and can stomach the potential short-term volatility from tourism cycles. So we've broken down OUE REIT piece by piece, looking at its strengths and weaknesses, and I've given you my personal verdict and strategy advice. If you found this level of in-depth, actionable analysis truly valuable, please give this video a like, share it with fellow investors, and subscribe to the Investing Iguana channel so you don't miss our future deep dives. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today. Before you go, if you're interested in another deep dive that explores sector trends impacting SGX, check out my video, The Future of Singapore's REITs, Opportunities and Risks in 2025. You'll find the link in the description.